TrendSynth, where AI meets insight.
The physical expansion of human civilization into the dark vacuum of space represents the single most capital-intensive endeavor in modern human history. To fund that expansion, SpaceX is taking the company public, targeting a valuation of $1.75 trillion. This chart ranks the world's most valuable companies. Above the $2 trillion mark sits an exclusive group, Apple, Microsoft, and NVIDIA. At $1.75 trillion, SpaceX immediately slots in right below them, bypassing the decades of incremental growth typical for a manufacturing firm. To reach that scale, the company is executing a $75 billion primary equity raise, specifically to build out deep space and artificial intelligence infrastructure. The mechanics of this offering violate the core operating principles of the public markets. In their amended S-1 filing, SpaceX published a rigid predetermined price tag of $135 per share, a full week before the listing. By dictating a fixed price up front, the company bypasses the banking protocols designed to discover what the market is actually willing to pay. SpaceX is executing the largest initial public offering in history. In the process, they are systematically removing the gatekeepers who control how corporations access public liquidity. For decades, Wall Street has relied on a mechanism called book building to take companies public. Investment banks poll institutional clients to set a final price, typically lower than what the market will bear. When trading begins, this artificial discount creates a vertical spike. It is a wealth transfer, leaving money on the table for the underwriter's favorite clients. SpaceX rejected this structure, abandoning book building to issue a non-negotiable price of $135 a share. This bottom track shows the new model. With no price discovery, the roadshow strictly allocates shares, forcing the market to accept the absolute valuation. Silicon Valley has attempted to bypass these banks before. In 2018, Spotify executed a direct listing, putting existing shares straight onto the open market. But Spotify raised no new capital. SpaceX requires $75 billion. To manage that volume of capital, they still hired a 23-bank syndicate, while stripping them of their pricing power. By dictating the terms of the sale, SpaceX reduced the world's most elite investment banks from market makers to retail distributors. Normally, that distribution comes at a steep cost. Underwriters extract 4 to 7% of gross proceeds to manage a public offering. According to the S-1 filing, SpaceX negotiated a base underwriting rate of under 0.75%. Why would 23 major financial institutions accept such a drastic cut to their profit margins? The incentive is relationship capital. These banks need access to SpaceX shares to allocate to their ultra-high net worth private wealth clients. To secure that access, Wall Street surrendered its profit margins. Power has shifted to the mega-cap issuer. Stripping away the banking mechanics exposes the financial reality supporting that unyielding $135 share price. This grid breaks down the valuation math. In 2025, SpaceX generated $18.67 billion in trailing revenue. Against a $1.75 trillion valuation, that creates a multiple of 93.7 times. Even projecting $28.5 billion in 2026 forward revenue, the multiple remains above 61.
For context, established tech companies typically trade closer to 10 or 15 times revenue. Compounding this premium is the operational burn rate required for space infrastructure, yielding a net loss of $4.94 billion. Traditional institutional value investors rely on models that reject capital-intensive, high-loss firms trading at 94 times revenue. To float $75 billion of primary equity at these metrics, SpaceX had to engineer a liquidity moat that is effectively immune to traditional valuation models. The first pillar of this moat is retail syndication. Standard megacap IPOs typically restrict individual investors to less than 10% of the total offering. SpaceX deviates from that norm. As this diagram shows, they are diverting up to 30% of the float, $22.5 billion, directly into retail allocation. To move that volume, they enlisted consumer brokerages like Schwab, Robinhood, and SoFi as primary distributors. Distributing shares across millions of accounts creates a fragmented shareholder base. This decentralized network cannot coordinate the massive institutional sell-offs that typically threaten expensive listings. Through a dual-class share structure, Elon Musk retains over 82% of the voting control, ensuring this retail influx has zero operational influence. By harnessing retail demand, SpaceX mathematically insulates its stock against early volatility and neutralizes institutional leverage. The second pillar of the liquidity moat is indexation arbitrage. Indexation arbitrage relies on the forced mechanical buying of an asset by passive investment funds. SpaceX initiated extensive efforts to secure rapid inclusion into major benchmarks like the NASDAQ 100 and S&P 500. ETFs like SPY and QQQ are governed by a mathematical mandate. They must perfectly mirror the weightings of their target index. If index inclusion is granted, it triggers an automatic capital influx of $8 to $12 billion in forced buying. It's a cannibalistic event. Funds must mechanically liquidate portions of established holdings just to finance the mandatory SpaceX purchases. These passive index funds are price agnostic. They are required to buy the stock regardless of a 94 times revenue multiple. By co-opting the passive index ecosystem, SpaceX engineered a guaranteed bid beneath its stock, securing the offering. The SpaceX IPO model is an architectural triumph of capital engineering. It fused the pricing sovereignty of a direct listing with the primary capital generation of a traditional syndicated IPO. Today, we are witnessing the emergence of massive trillion-dollar corporations capable of operating entirely outside traditional financial bounds. This structural shift establishes a template for the multi-trillion-dollar AI listings expected to follow. OpenAI and Anthropic are already being signaled as the next test cases for this framework. By proving that elite banks will work for less than 1% to secure high-profile allocations, SpaceX has reset the pricing for institutional access. Elon Musk secured the capital to expand a space empire. More importantly, he proved that the Wall Street underwriter is no longer the market gatekeeper. The corporate issuer now dictates the terms.